Now is the time for action. To be a force for good. To be more than just a bank. Money alone cannot solve this crisis, but it can help secure our future. Because what we do today determines what we become tomorrow. That's why at Standard Chartered, we're taking action today. We're financing the production of essential equipment, providing funds for emergency relief, and helping communities recover by protecting livelihoods and educational opportunities. So when tomorrow comes, frontliners can return to their families. Communities will emerge stronger, and people still have a roof over their heads. Because we're here for today, here for tomorrow, here for good.
Good evening, good afternoon, and good morning to everyone. Welcome to Standard Chartered's Global Research Briefing, and welcome to our Economic Outlook for 2021. My name is Eric Robertson. I'm the Global Head of Research for Standard Chartered, and I'm delighted and privileged to be with some of my partners from the Global Research team today, some of our thoughts with you. I'm with Kaushik Rudra, our Head of Research in Asia and our Global Head of Credit and Rates Research. Also joining us, Razia Khan, our Head of Research for Africa and the Middle East. Sarah Hewen, our Head of Research for Europe and the Americas. And working our way back east, Edward Lee, our Head of Economics for ASEAN and South Asia. Before we get into the discussion today, just a couple of housekeeping items to walk through with all of you. Your microphones are off, your video cameras are off, but throughout the presentation today, you will see that on the right-hand side of your screen, there are some icons where you can pose questions through text. We have a couple of polling questions to ask you. You'll see a polling icon where you can cast your vote. If you need to communicate with the moderator, you can do that as well. And finally, we do ask that if you're so inclined, you do offer us your feedback on the presentation later today. So with that, let's get started. 2020 has been a year that was obviously very difficult to predict. As we came into the year, most people expecting a moderate pace of growth on a global basis, perhaps some speed bumps along the way, but nobody anticipated the kind of economic and health crisis that we've all lived through. Now, amazingly, if you look at financial markets, we seem to have already put the global health and economic crisis in the rearview mirror, and we are looking forward to better times ahead. Is it always so clear-cut? Is it always going to be so easy? Not sure. But thankfully, we have four all-stars from the research team today to share with you our views and outlook for 2021. Before we get to the team, I do want to start the presentation with a polling question for all of you. So if we could bring that question on screen, we'll start there. Quick and easy question. Where do you see the biggest risks to the global economy in 2021? Is it the ongoing COVID impact? Is it a resurgent inflation? Perhaps geopolitical tensions, US policy gridlock, or the China debt crisis, or a China debt crisis, excuse me. So please register your vote. We will gather the answers and come back to you shortly with the results of the poll. Now, diving right in, Kaushik, if I can bring you on the proverbial stage. I think it's fair to say that the consensus out there expects a fairly significant economic recovery in 2021. I was wondering if you could share your trajectory of a possible vaccine and then what that means for the shape of economic recovery next year.
Thank you, Eric, and thank you to everyone for taking the time to join us for today's call. I was looking at your question. I'm not sure the answer is that straightforward. I think we have, I think those are all fairly equally important issues that the world will be facing. But I think the vaccine actually towards the end of the year has been a real game changer, and it's it's going to be a real factor going into 2021 and beyond. I think we've had some shock. I mean, there's understatement to say, to talk about what kind of shock we've seen this year. I think we will have an output gap that will probably last with us for some time to come. I think we will see, the world sort of combat this output gap for the better part of the next 18 to 24 months, if possibly. I think if you look at the growth story today, we will probably see an economic recovery in 2021. I mean, that is largely on the back of base effect and sort of rebound from where we went to. And that's going to be sort of welcome for the world. Obviously, a lot of that will be driven by the vaccine. The first half of the year will be challenging. I mean, I think we will have continued sort of issues that the world will see. But as we get into the second half, the vaccine will play a much more important role in sort of rebuilding the world and a more robust recovery taking place. If you think about the vaccine, I think countries which have pre-existing sort of agreements with vaccine manufacturers probably are better positioned to sort of recover. US and Europe probably will see sizable portions of their population either vaccinated or access to a vaccine by late 2021. Emerging market story will be quite different, right? And EM, I think we're likely to see a very different stories. In Africa, for instance, will largely rely on a multilateral effort led by the WHO to support its vaccine effort. Countries like India and Indonesia, which have vaccine available or sort of agreements in place, I think even there it's going to be challenging given the logistics involved, the size of the population, and very sort of tough nature of distributing this vaccine across the country. So we'll still have a much lower population vaccinated by end of 2021, and that clearly will drive how the sort of differing recoveries will take place. I think DM will be in a better position to recover quicker because of the vaccine, EM probably slower, but we will still see this output gap with us for some time to come, and I think that will clearly drive the policy response from major central banks and governments around the world. I'll stop there. I'm sort of, we can get into this issue in a little bit more detail at a later stage.
Sure, and just so people are not waiting on the edge of their seats, we have the results of the first poll. It looks like we're going to spend another year honing our skills on COVID and geopolitics. The audience believes that roughly 60% of the audience believes that COVID and the lingering impacts of the health crisis will be the biggest risk to the global economy. 21% think geopolitical tensions are the biggest risk. And then there's a big tail. And we go down to inflation, where 8% of you are focused on that risk. China's potential debt crisis, 7%, and US policy gridlock, only 5%. Now, Kaushik mentioned the different speeds of recovery and touched on Africa, for example. Razia, if I could jump to you for a moment. On a global basis, we see 2021 growth of nearly 5%, 4.8% is our outlook. Africa is going to grow at a meaningfully slower pace, closer to 3.6%. And I wondered if you could talk us through some of the key themes and tensions that you see for Africa and the Middle East next year.
Thank you, Eric. So you're right in that we do see a technical recovery in 2021 across both Africa and the Middle East regions, but this is really off the very weak base. In both instances, there are a number of headwinds that are going to be important. Africa, first of all, let's consider what happened during the COVID crisis. Thankfully, the health impact of the coronavirus crisis was nowhere nearly as negative as initially feared, but the economic impact looks to be a lot more long-lasting. There are concerns in a number of economies that the decline in growth, the outright contractions that we will have seen in some key economies, South Africa, for example, just yesterday we had more upbeat news, a much better than expected Q3 GDP print. But at the peak of the coronavirus crisis, the thinking was that this would take growth back to where it was in 2007. In other countries, we know that we have seen, as a result of the COVID containment measures, a fall in per capita incomes, a rise in poverty levels, and the big macroeconomic concern for the region as a whole is that with governments having seen significant strains on revenue, there wasn't ever that much fiscal space to be able to spend their way out of this crisis, but the big hit came from the revenue fall off, wider budget deficits, adding meaningfully to public debt ratios. It's not going to be very easy for many governments to come through with fiscal stimulus packages, to play a big role in public investment, which has been a key factor driving growth in Africa in the past. So a technical recovery in 2021, still fragile and still vulnerable in some places, and the key point that Kaushik had made about the vaccine availability. Now, there is optimism, of course, on a global level because of what we've seen with vaccine developments, but real logistical and funding issues that still need to be resolved for Africa. How about the Middle East? For the region's oil producers, the growth outlook, of course, is going to be impacted by this need to comply with OPEC plus production quotas still. And we saw some of the tensions coming to the fore in the recent OPEC meetings, where it took a bit longer in terms of deliberations to reach that consensus. Within the region, there are, of course, different growth prospects. Countries like Egypt, part of an IMF program, seen as a strong reformer, probably likely to surprise with better growth sooner, although it will take a while for sectors like tourism to recover. The region's oil producers, very much impacted by the hit to production quotas, and the GCC a particular concern for the medium to longer term is, of course, this anticipation that we could be seeing a decline in the population size. As a result of the COVID crisis, the rise in unemployment, the fact that many expatriates may well be leaving the region, this could take away meaningfully from non-oil demand. It is a question that policymakers are going to have to grapple with, but it is likely to act as a drag on growth. So for both of these reasons, yes, recovery in the region, but it's not yet a return to pre-COVID levels of GDP just yet.
Thank you, Razia. That's great. You've mentioned a number of risks for the outlook, and as we shift to developed markets, I wanted to ask you, Sarah. If I look at our economic outlook for next year for Europe, it is, I think meaningfully stronger than what we see for the U.S. And I wondered if you could talk a little bit about that growth differential and also some of the to the European outlook.
Yes, thank you, Eric. The rebound that we expect in Europe next year, I think, is in contrast to the very deep recession that we've seen this year. So the starting point is so much lower in Europe. Europe, of course, countries have seen amongst the highest numbers of COVID cases. For the Europe and the US have experienced the highest death rates globally, and that's been reflected in the deterioration in the economy that we've experienced this year. The profile for Europe is slightly different than for the US. So at the moment, Europe is in recession again, with the second wave of COVID having resulted in quite widespread lockdowns and disruption to the economy. We are coming out of that now, so we're seeing the COVID cases declining finally, and we're expecting that growth will turn positive again in the first quarter of next year. So Europe gets off to a slightly better start next year than the US does. The US situation, unfortunately, is one where, in terms of the pandemic, the second wave, it's hit the US several weeks later than in Europe. and we're up at over 200,000 daily COVID cases at the moment, with a sort of death up at over 850 per million. So a pretty dire situation in the US. Unfortunately, the risk is that doesn't improve. We're in the holiday season at the moment. And although the economic data have held up surprisingly well through October, through November, we're now starting to see some signs that activity is fading. And we think that we could see the US economy in the first quarter of next year turning negative again. So we have this strange situation where there's a lot of optimism, a lot of market optimism for very good reason on the vaccine news, and yet the immediate situation for the US and for Europe is pretty dire economically. The story that we expect to unfold for next year is one where vaccinations, I think as Kaushik mentioned earlier, vaccinations will gradually cover an increasing share of the population in Europe, in the US. We know that in both cases, governments have ordered enough doses of the vaccine several times over to cover their populations. So the question is more one of, is there going to be resistance? How many people will be willing to take the vaccine? How big a share of the population will refuse? We think that the impact will be most obvious in the second half of next year, both for the US and Europe. And just to finish off on a couple of the reasons why we're looking for particularly strong growth in the second half of next year for the US and for Europe is, first of all, in both cases, we've seen a big rise in savings rates. So in the US, savings, household savings have doubled since pre-COVID, and in Europe, savings are up about 50%. So this is spending that can be unleashed, particularly for the services sector in both economies. We still see services well below their year-ago level, even though retail spending on durables, non-durables has picked up. So that's one very good reason to be optimistic about the rebound later next year for major markets. The second is that we think that we will see some ongoing fiscal support, although there's more of a question mark over that, and very supportive monetary policy as well. I'll stop there.
Thank you, Sarah. Edward, I'm going to ask you two questions wrapped into one. If we think about the outlook for Asia in 2021, most people have been, I think, rightly focused on the extremely rapid recovery that we've seen in China and the growth differential between China and the rest of the world. I wonder if you could offer some insight into how we view China's economic narrative next year, but also what we think that means for the rest of Asia by comparison.
Thanks, Eric. I think in terms of China, we need to be cognizant it's one of the few countries in the world that has really done well this year, right? I mean, we are looking at a positive growth rate at about 2.1% for 2020. You pretty much have very few countries managing that. And next year, we are looking at 8%. So on average, we are looking at 5% sort of growth rate for China, which is maybe slightly below potential. But it's still a good growth rebound, right? Considering that this year, its base isn't as low as other countries. But if we are to take a look at China's growth on a sequential basis, I think that gives a better sense of how it can compare, how we look at China's growth versus the rest, right? Number one, the sort of China growth outperformance on a full year basis will certainly be lesser in 2021 than 2020, okay? And the second key point I'd like to highlight is the sort of sequential growth we should expect, right, from China. I think we have the pent-up demand, right? We have the initial huge boost to the economy. We are looking at the leverage increase or in 2020 of potentially between 20 to 25 percentage point of GDP. Now, less than during the GFC time, but it's still significant. But as we go into next year, I think China is all about policy normalization, right? We are not expecting them to tighten things. Certainly, there's not much need to, right? Potentially, we could even go into a deflation at the start of the year, mainly due to pork prices, right? But even then, we are looking at a very benign core inflation picture of between 1 to 1.5%. And given the higher interest rates, there's really no need to tighten. But at the same time, I think authorities are very cognizant of they do monitor the sort of leverage levels that we are talking about that will be closer to about 280% of GDP by the end of this year. So next year, from a policy impulse perspective, I'm expecting something to be slightly between more neutral to be even slightly negative. But certainly, we should not be expecting any policy cliffs. So, for example, looking at the fiscal deficit side, this year probably they'll underspend, but still we're talking about 8 percentage point of GDP. Next year, where I'm talking about the broad deficit number, next year probably we're looking at a pullback, right, just to manage things a bit by about 6 percentage point, right, from 8% of GDP to about 6%. And on the monetary policy side, probably we think they are done, right? We don't think they're going to ease any further beyond trying to keep the total social financing about 10 to 11%, right? Total social financing this year probably runs at about 13 to 14%. But the signs are very clear, right? If you take a look at the Q2 versus Q3 GDP print, credit to GDP gap in Q3 was about 1 percentage point. In Q2, it was about 3 percentage point. So that is already happening. And as we go through next year, I think this is how China will look like. Still growing nicely, right? 8% growth, average 5% growth over 2 years. But on a sequential basis, slowing down as we go through next year, and the growth differential with the rest of the world certainly becoming narrower.
You've all hit on some fairly interesting points, and I want to dig deeper into a number of them. But before I do that, I'd like to give the audience another opportunity to participate in one of our polls. If we could bring up the next polling question. Now, you've heard a fairly constructive view on both the global outlook and the emerging market outlook from Mike. Which region or provide the best business and investment opportunities in 2021? Is it Asia? Is it Africa? Perhaps the Middle East? Or is it Europe or the United States? Please use your voting button and let us know what your thoughts are on this set of opportunities for next year. Now, Kaushik, I want to bring it back to you because, we've heard from the members of the team, and in fact, most of us know from our client conversations that there is generally a reflation mindset amongst our clients, both on the corporate side and on the investor side. And this reflation narrative, dare I say, has become the consensus, and most people do seem to buy into this view. I wondered if you could tell us a little bit what your thoughts to that view, the vaccine aside. Obviously, if there's a failure on the vaccine front, that would be enormously damaging. But vaccine aside, what do you see as the big risks for emerging markets?
Well, risk to emerging markets, I guess there are a few, but I think on the issue of inflation, what I would say is if you hit upon a very important point at the beginning of this session. You talked about our expectations going into 2020 were fairly or subdued growth. If you look at what our growth rate was, global growth rate for 2019, we were at 2.9%. That is also well below sort of the average growth rate over the last 10 years. So we've been running at a below potential growth rate for some time. And then obviously we have now just created a massive output gap, which will clearly have a very profound impact on demand conditions globally. So which effectively means that I think inflation, particularly from a demand side, is likely to be subdued for some period of time. Conversations with central banks in the lead up to the COVID crisis was very much around downside risk to inflation. And I think central banks would have tolerated or would have wanted to see inflation run a little higher or probably towards the upper end of their corridor before they would have wanted to do something more sort of, significant in terms of tightening of policies. Now, I think demand conditions, we feel reasonably, given sort of the global growth situation and the output gap, I think demand-driven inflation probably remains subdued. I think where there is risk is probably coming more from supply side standpoint. There are clearly logistical challenges. There are supply bottlenecks, which will create short-term disruptions, causing prices to go up. We've seen food prices go up in a number of jurisdictions. We have seen cargo prices go up in China. We have seen shipping prices. So a lot of things sort of clearly getting impacted, which could impact raw material prices. And that could be something that obviously sort of throws off this very delicate balance of, and I think that's something that policymakers will watch. I suspect policymakers will want to see through short-term issues and focus on more longer-term issues. And there, I think our view at least is that core inflation remains subdued, and for the time being, this accommodative stance that they have in place will sort of keep supporting the global growth recovery. Now, if of course things change quite dramatically because of something that becomes a little bit more persistent, I think central banks will have to respond to that. But we, at least at this point, we don't feel that is the case.
Just before we move on to the next question, I just wanted to share with our audience the results of the second poll. If we think about the investment and business opportunities for next year, 76% of you think that the best opportunities will be in Asia, 11% in Africa, Europe and the US, 8% and 4% respectively, and the Middle East trailing with a several percentage points audience response. Now, Asia is obviously the elephant in the room. People clearly think that that is going to be the big driver of growth as well as business and investment opportunities. But I also find it interesting that there's a meaningful percentage of people looking to Africa. The other clear trend here is a big focus on emerging market opportunities, and I think that is consistent with the views of the team. Razia, if I can move back to you for a moment. You mentioned one particular country and the sort of volatility around economic data. That was South Africa. Another country in your coverage space that has been spending quite a bit of time in the spotlight lately is Nigeria. And to use your words, there has been a flurry of activity, especially with regards to foreign exchange. I was wondering if you could share with the audience your thoughts there, please.
Thank you, Eric. So, to look at this poll, it seems as though despite the impact of the COVID crisis, there is still cautious optimism around growth prospects in the region. And when it comes to somewhere like sub-Saharan Africa, we've said for a long time, the underlying growth fundamentals, the younger demographic, the fact that we will over time see a continued urbanization trend. Yes, there was a bit of a reversal around COVID, but that's very short term. That these are still longer term drivers of the growth potential. But what do we make of prospects in the two big economies, in South Africa and Nigeria in particular? The slowdown, in a sense, didn't come to Africa just because of COVID. We had seen a multi-year period of disappointment of growth in South Africa, which had seen negative per capita income growth since around 2013, and in Nigeria as well. Since the end of 2014, the collapse in oil prices, it has been a tough time for the Nigerian economy. The question now is, will we see enough momentum to ensure some kind of escape velocity in terms of the country's recovery trajectories? And a lot is going to depend on policy. South Africa first. The upside surprise yesterday is 66% annualized growth rate in Q3, really just reflecting the weakness of the base. South Africa had one of the strictest lockdowns in the world in the second quarter, a lot of pent-up demand. Edward mentioned that this is a theme we see across Asia as well. And the question is, how much should anyone be reading into that sort of growth trend? A lot will depend on the policy support. We are expecting in 2021 that there will be meaningful changes at the state-owned electricity company Eskom, which so far has been a big structural factor holding back growth in South Africa. There is an embrace of renewables going on. Finally, the understanding that there needs to be much more encouragement of self-generation of electricity. It may not be great news for the electricity utility itself, but it could potentially remove an important bottleneck from growth. Nigeria has had a difficult time, and there's a lot of focus right now on foreign exchange reforms in Nigeria. We all know that Nigeria has requested World Bank funding. That's going to come up in mid-December for deliberation, and the World Bank and other IFIs have made it quite clear what reforms they'd like to see from Nigeria. The lifting of fuel subsidies, that's absolutely key for an oil producer like Nigeria, and we've seen positive developments in terms of that subsidy removal. Power sector tariffs, also long a constraint on investment and growth in the country. This is being addressed, but we think that these two reforms make it even more important for policymakers in Nigeria to ensure relative FX stability. So there has been a drawback in terms of the preparedness for a full-on recovery, and that has been that foreign exchange policy in Nigeria hasn't always helped with price discovery. It hasn't lent itself to Nigeria attracting a lot of inflows from foreign portfolio investors, for example. And we don't expect to see big, meaningful changes in the near term. We think the authorities will prize social stability, will give prominence to the other reforms that are taking place that make it even more important that Nigeria has relative stability in its FX rate going forward. So Africa's two big economies, South Africa, we are expecting to see something more of a structural turnaround in 2021, not just that cyclical recovery, but a lot of tests we've still got to monitor progress. Nigeria, tentative signs of reform, but very much at a gradual pace. And this will be important to what we ultimately see in Nigeria.
Thanks, Razia. That's super helpful. A theme that seems to be creeping into a number of our discussions is inflation. In some cases, a meaningful pickup, and in some cases, the lack thereof. Sarah, we have all been waiting for inflation to finally rear its head in Europe. Do you think 2021 is the year where we're getting meaningful growth, that we may actually see inflation? And if you could perhaps also talk about the inflation outlook in the US, where the Fed is actively trying to lift inflation to its average inflation target.
Yes, I mean, the situation at the moment in Europe is negative. So we have prices falling, we have negative headline inflation. And I mean, that's partly because of special factors, the VAT cut in Germany, the oil price impact as well. Now, that will turn around. So we could be in a situation in the second quarter of next year where actually inflation is rising quite rapidly. That's very much factored in by the European Central Bank. We don't think that they're going to see that inflation doing what it should be doing. We'll get updated forecasts from the ECB tomorrow, but our own view is that we will have inflation in the euro area below targets this year, next year, 2022, and I'm expecting that the European Central Bank will also be signalling that. Of course, you did mention a couple of interesting points which we should sort of bear in mind. That's on the supply side. So I've already talked about oil prices, the fact that year on year we've already seen oil prices almost up 100% compared to the low point of the second quarter of this year. There's also the potential, because we've had such a disruption to the economy via COVID, the sort of permanent scarring of the economy is something the European Central Bank's chief economist talks about in particular, and that scarring and lack of investment, lack of capacity could mean that as demand comes through, you don't have the supply side response. So we may get a situation where we do start to see inflation in some sectors picking up more than expected. Services could be one example. But we know that services is one area where we've seen deflation in particular. For the US, yes, I mean, the Fed continues to signal that it's going to be comfortable with inflation going above target for some time, and that's really to compensate this prolonged period of below target inflation. So making up, sort of make-up policy really, allowing inflation to go above target, to really embed price setting in the economy again. The risks, I think, in the US, perhaps similar to the euro area, perhaps a little bit more on the inflation side. We're expecting to see core inflation moving up to 1.8% next year. So that's below target, but it certainly looks as if it'll be a bit closer to target than the ECB is able to meet. I mean, I think it's right to focus on inflation as one of the risk factors. We know that policy mistakes from central banks in the past have been very disruptive. We know that the European Central Bank has got a history of being too soon. And even though the message at the moment from the ECB is very clearly that they're set to ease further, that's what we're expecting tomorrow, then as we go into next year, later next year, they will need to unwind emergency policy, and they will need to do that in a very careful way that doesn't upset markets. And same for the Fed as well. The question is, having expanded balance sheets so far for such a prolonged period, how do central banks gradually start to reduce balance sheets without a repeat of the taper tantrum that we saw back in 2013. So it's never easy for central bankers, but it's a particularly challenging time at the moment.
Thank you, Sarah. Shifting gears from the inflation debate, perhaps back to something near and dear to all of our hearts, which is trade and the momentum of exports and supply chains. Edward, you and the team were quite early in identifying that emerging market exports had recovered to pre-COVID levels, and that recovery had happened at a much faster pace than after the global financial crisis. Sitting in Singapore, I wondered if you could offer some insights into the outlook for global trade next year and what the implications might be for supply chains with a new U.S. administration.
Sure. I think sitting here, I can still see a lot of ships out there, but probably they're carrying a lot more goods than they were quite a few months ago. So indeed, I think what we saw was certainly electronic exports doing really well. And I think, look, at the moment, probably we are starting to see a pickup, still in negative territory on a year-on-year basis, on commodity exports from this region, and also the non-elect, non-commodity sort of exports. Now, as we look forward to next year, we do think that the trade environment should actually still look good, right? Especially as major economies continue to recover, in our view. But we are starting to think maybe the peak in electronics demand is not too far off, right? I mean, we had great electronic demand from working from home. There's advanced orders ahead of sensitive sales of some components to Chinese companies. We have the inventory rebuilding of electronic components after the COVID situation. So it has done really well. And probably, we still get a bit of the 5G cloud demand sort of a situation. But probably that has, in terms of electronics exports, that has sort of peaked for us. Not to say it's going to be into recession, but probably it's now about the rest catching up. And in terms of commodities, we have seen commodity prices recovering, right? So that should be one area where we see it mitigating some of the easing in terms of the electronic exports, right? And of course, we have the rest of the goods, right? And already automobiles, for example, over the last 2 months, we have certainly seen that pick up in the exports as well. So going forward into next year, probably I think at this moment, we are generally expecting a positive trade environment, global economies grow better, and also Biden presidency, right? I think if we just go back a bit in history, 2019 was actually one of the worst years since global financial crisis. Of course, on hindsight now, I would love to have 2019's growth, right? But at that point, that was pretty bad. And that was all the Trump tariffs, etc. And in terms of how we are viewing things, probably Biden's presidency, when it comes to some of the trade with China, etc., probably still hard, but certainly less erratic. And I think that has sort of a filter on sentiment impact for the rest of us, right? If we have a more stable sort of a global geopolitical environment between US, China, which we have seen really affected global trade in 2018 and 2019, possibly again, I think that adds to the positive side of this global trade environment. And maybe just one more thing I'll add is also this growing trade corridor between China and actually ASEAN. Pretty interesting, right? Pretty interesting stuff. If I take a look at the last 1-2 years, what has happened with ASEAN is that ASEAN has increased its trade share with China and also increased with the US. Okay? I mean, partly I think ASEAN is becoming the point where it is helping to deal with sort of a trading relationship between US and China, but certainly I think ASEAN is sort of seeing that bit of the benefit from this geopolitical tension. Of course, if it gets negative, then it's all negative for everyone. But from that perspective, it actually adds to the trade outlook for this region next year.
Thank you, Edward, and thank you all. We're going to shift gears a little bit. We're getting a number of really terrific questions from the audience coming through in the chat, and I wanted to give all of you a chance to answer those questions. I think we'd all like to put COVID out of our minds, but I think the topic of the vaccine is going to be hard to escape in 2021. And so far, one of the most popular questions, I might direct this to Kaushik, is do we anticipate that the inequitable distribution of the vaccine may lead to either intra-country or geopolitical tensions on a regional or global basis?
I think that's a great question. I think this sort of widens the divide between the haves and the have-nots, and clearly will have impact from a global growth standpoint. But I think the rest of the world is also finding a way where they don't have vaccines to sort of deal with it in other ways. It's not ideal, but I think you are starting to see some herd immunity getting built up, particularly in some of the emerging market countries. You are seeing demographics come to their rescue. There are lots of other things that are sort of aiding that whole process of, I guess, recovery. Vaccine would be ideal, and that would help hasten that whole process. But I actually don't. I mean, clearly, I think the divide will widen, and the growth discrepancy could, in some cases get even more exaggerated. But I don't really see tensions arising around the world. I think the world has taken a much more multilateral approach. If I see the example of middle and low income countries and how the WHO and other agencies, public-private partnership is coming to their aid and sort of supporting that whole process, I think the world is awakened to that fact. Yes, I think on the margin, you could have some, issues, but I don't think we expect any major geopolitical issues sort of stemming from this. I don't know, maybe, Raja, do you have a different view on that?
very much similar, Kaushik. I think, one of the questions or the themes coming through the question that we've received is not so much just in terms of the vaccine and the equitable sharing of that, but are we likely to see, as a result of the recent triggering of greater inequality, that much more social tensions being evident, especially across emerging and frontier markets? Policymakers have spoken a great deal about the likelihood potentially of a K-shaped recovery. Yes, a great deal has been done in terms of the monetary accommodation, trying to keep things as beneficial as possible towards helping that recovery. But is there a risk that people on slightly better incomes, that higher income segments of the population will benefit and will see that recovery? And are we going to see a deepening of that inequality? Essentially, the question being asked about the K-shaped recovery. And I think this is going to be a very important issue for policymakers to grapple with the world over in terms of how policy can be formulated to help along this recovery. So the vaccine and, access to the vaccine is an important part of it, but the underlying issues run much deeper than that.
Thank you both. I want to return to the topic of central banks and specifically the Fed. I think all of us on this call would like to believe that a number of the countries and regions that we focus on can operate idiosyncratically. But as we know from 2018 and back in 2013, when the Fed tightens, it has an impact on the global economy and global markets. So a question that's coming from the audience is, and maybe this is for you, Sarah, with markets being high on liquidity, how do we see the impact and the potential timing of the Fed starting to unwind its excessive balance sheet expansion and excess liquidity?
Yeah, sure. I mean, it's a key question, and next week we're expecting to see the Fed accelerate its purchases. So the balance sheet expansion will continue and pick up further. And that's really reflecting the current weakness, and I think some concerns as well about whether there's going to be fiscal support coming through either by the end of this year or once we get a Biden administration, how far there is going to be any agreement in Congress to underpin the economy through fiscal measures. But I think there, at the same time, policymakers don't like the idea of running an emergency policy stance for a very, very prolonged period of time, particularly when the economy starts to normalize. And our own forecasts, as I said, are that the early part of next year is going to be weak, so we're not expecting to see the Fed changing policy direction in the early months of next year at all. But by the second half of next year, we're thinking that the economy could be growing at a very punchy pace, around 8% annualized, as all these sort of stimulus measures come through and the savings are put to work and businesses start to invest again. Now, under those circumstances, it would be very unusual for the Fed to continue running an policy at an emergency dial. So that's when we're expecting to see some winding back of the stance. Now, we're not talking about the Fed stopping QE or reducing its balance sheet, but just starting to slow the pace of purchases and ultimately stabilizing the balance sheet before then thinking about reducing. So this is going to be a slow and gradual process with one eye very much on markets. It will be very clearly flagged as well. The lesson from the taper tantrum of 2013 was that markets need to have good warning. They need to know clearly, have clear forward guidance about what is driving policy, and therefore that's we hope will be a smooth process. We've got long-term yields, we think, will be reflecting a sort of changing Fed policy stance and the strength in the economy by the end of next year. So we do have yields breaking up through 10-year yields breaking up through 1% and moving up to 1.4% by the end of next year. So somewhat of a move out of the sub 1% range that we've seen for quite a while now.
Thank you, Sarah. Razia, we are getting a handful of questions in the chat regarding the debt markets for African countries. A couple of questions here for you. What kind of a risks are we assuming for debt distress in African countries? And how helpful will growth in 2021 be towards allowing African countries to start servicing their debts in a more productive way?
So this is a really good question. We know that the G20 Debt Service Suspension Initiative, for now, it lasts until June 2021. And for many countries still wondering if they should go for the DSSI or not, the question is, how much debt service relief, debt payment relief are they likely to get, given that it's fairly short term? But there's also been the adoption of the Common Framework Agreement, where there seems to be much more consensus, certainly amongst G20 economies, amongst the IFIs, that if countries have unsustainable debt loads, this is probably something that should be dealt with right up front. I think the question is saying, we know that the COVID crisis has been a very trying time for many different sub-Saharan African economies. Should we anticipate that we're going to see more countries falling into debt distress? And if you look at what has happened so far, economies like Zambia, probably having had an unsustainable external debt load for some time. COVID may have helped to exacerbate some of the pressures, but it was inevitable according to the way Zambian euro bonds were priced, for example. There was always this thinking in markets that a restructuring at some point had a certain inevitability about it. So the question facing a lot of sub-Saharan African issuers, but a lot of other poor countries is this return for growth going to be sufficient? We think, first of all, the policy response, the fact that IFIs, international financial institutions, look to be getting a lot more involved with different countries, there's going to be an upfront request to do what may be necessary to achieve a more sustainable debt load. The second part of this is we know that we might see a technical bounce in growth if we're looking just at 2021. The real question is, does that lead to a meaningfully better revenue performance? And that is still the subject of some uncertainty. Nonetheless, we do think that the countries that were at high risk of debt distress are well known about. You know, markets have already priced in the likely developments there. It's very unlikely that we will see more of those countries with debt ratios of around 70% of GDP tipping over. We think we are seeing enough corrective action early enough to stop this from happening.
Now, I wanted to avoid offering any of my own commentary here, but there is one question that's coming up repeatedly in the chat, which is with regards to our US dollar view. A few clients have asked, what would change our negative view on the US dollar for next year? I'll give a couple of thoughts. The first of which is that our dollar depreciation view rests partially on the idea that we will continue to see an improvement in global growth, led especially by emerging markets. And that will lead to a reallocation of capital away from safe haven currencies like the dollar to higher yielding and better performing currencies in EM, especially in Asia. If we were to see a material loss of economic momentum, if, for example, China were to lose momentum, or the rest of Asia were to lose momentum, that would be a source of concern for us. If we were to see a significant correction in commodity prices, that would also be a cause for concern for our bearish dollar view. And the final comment I would make is that we have seen a meaningful deterioration in the deficits of the United States. The budget deficit has obviously gotten worse, like many countries around the world, but we've also seen the worst trade deficit in 15 years, and the current account deficit in the US is starting to deteriorate as well. If you were to see a reversal of those trends, if you were to see a move towards perhaps some fiscal discipline, if you were to see the trade deficit start to improve a bit, that might offer some support for the US dollar. So again, just a handful of items that we are paying close attention to. But for now, based on the views that you've heard from my partners and colleagues today, we think the dollar down story or the dollar depreciation story remains intact. We're getting down towards the end here, but there are a couple of questions which are sneaking in. Back to you, Edward, on Asia. We've talked a lot about trade today. We've talked a lot about exports. Are there other drivers of growth in the region that you see for 2021, whether consumption or public spending?
Sure. I think when to answer this question, I think we have to be very cognizant of the risk of looking at the year-on-year basis, because a lot of it will be base effect. So when we run our numbers, private consumption will look very good, right? But I think we have to be very careful that's a base effect. So I'd like to answer this question from a sequential basis. And from a private consumption perspective, actually minus the pent-up demand that we have in most places in Q3 this year, I would like to think it sort of plateaus off in terms of private consumption. Why? Partly, I think we take a look, partly was pent-up demand, everybody gets to spend now, right? A lot of supply side easing, allowing you to spend. But going from Q3 out to say first half of the year, assuming widespread application of vaccine, not only in the late second half of the year, right? We are still talking about a labor market that is not back to pre-COVID levels, right? That's number one. Wage pressures probably low, right? And also, I think some of the wage subsidies, some of the income substitutions probably run out by 2021. So from a sequential basis, I think private consumption comes in as a stronger play maybe in Q4 next year. But meanwhile, public investments probably will play a stronger role in the first half of the year, right? I think if we take a look at the sort of fiscal budgets across the region, there's a bit of a tightening of the fiscal deficit, but not necessarily a negative fiscal impulse, right? Expenditure probably is still a large part of the GDP and probably higher, but a good portion is now put back to medium-term development. Infrastructure is a favorite word in this part of the world, right? I mean, we see the reallocation of infrastructure back to Indonesia after taking off some to deal with COVID, similar in Malaysia, similar in sort of Philippines. So from a sequential basis, public investments probably play a bigger part. Of course, we have to be cognizant of the risk, right? I mean, construction sector was one of those that was the most deeply hit when the lockdown came, right? I would like to think with better SOP, better management, better experience of dealing with COVID resurgence, probably the supply side of the story on the construction sector probably doesn't hamper the sort of increase in allocation. So to summarize my answer, probably in the first half, public investments play a bigger role on a sequential basis before widespread application of a vaccine allows private consumption to take on a stronger role towards the end of next year.
All right, I muted myself. Thanks, Edward. We're coming up to the end of the hour here, and I wanted to give the audience one last opportunity to share their views with us. If I could have the last polling question, please. Oh. Here we go. For those of you focused on ASEAN and South Asia, if you would please tell us why you are investing in the region. Is it new growing markets, a more competitive labor force and a business costs, free trade agreements, or diversification due to the worsening US-China relationship? Please do share your vote with us before we wrap up the discussion for the day. In wrapping up, while we wait for the results of the poll, I'd like to take the opportunity to thank everybody for participating today. We had a really fantastic turnout. I know I speak for all of my partners in saying that we appreciate the questions that you've asked today. And I would like to say on behalf of all of Standard Chartered We are enormously grateful for your support, your ongoing commitment to our bank and our business. And we hope that we as a research team can continue to be useful and provide valuable insights to you in the new year. And I know we all look forward to seeing you face to face when travel resumes. Irma, do we have the poll yet? Okay, so final results. You investing in ASEAN and South Asia. 44% have said they wanted exposure to new and growing markets. 35% want diversification due to the US-China relationship. 16% are seeking competitive labor and business costs. And finally, 5% of you are most interested in access to free trade agreements. So with that, we've hit 1 hour right on the button. Please do share your feedback with us. We're keen to know how we've done for you today. And as I said, thank you all for your time, and we look forward to seeing you in 2021. Thank you very much.